Hello and welcome to a brand new show of Market Makers. August was stormy, September was choppy, and October so far has turned out to be a stable month for both local and global markets. But where do we go from here? Earnings, they still continue to disappoint, but the macro tailwind is still there with us. Flows thankfully have reversed, but what about the other basic concerns about valuations and about emerging market concerns? Let's connect the dots with a market expert. And my guest on the show today is someone who we've seen before on this edition of Market Makers. I've always said that he's one of the best macroeconomists in the country. Neil, fantastic to have you back. Thank you for joining us. Let me take the clock back. When we interacted last, that was in the first week of August. China was the concern. China is still a concern. Growth is uneven, but world has moved on. Why is that?
No, I think nothing moves in a straight line. So the bigger concern in my view is now outside China. I think Chinese growth has been slow, but I don't think it's plummeting. I mean, there are signs of weakness, but there is no cataclysmic fall. There are parts of China which are actually doing very well. So on the services side, like if you see movie hall attendance, you look at some sorts of sales, I think numbers are not looking as if they're plummeting off a cliff. I think the bigger concerns are in economies which had current account deficits and were commodity exporters. And these economies necessarily, in order to balance their payments, external payments, need to bring down their import levels. And for that, the currencies have to fall. Now, this adjustment process can take 6 months to 18 months to maybe 2 to 3 years. And that is the biggest concern I have. And that never happens in a straight line. So what you see is a real or a ruble falling very sharply. Then the market thinks maybe it's overdone, that maybe, the economies are not that bad. And then we saw, and you could see this rally coming in September when the real bounced, when the ruble bounced. In the last week or so, we are seeing them fall again. And my fear is that we are in for another choppy period. So increasingly, I think the signs and the signals will come from markets other than China, the commodity exporters. I mean, if oil stays at 45.50, we will continue to see waves of redemptions. And just today, there was a news article talking about Norges Bank seeing its worst quarter, right? Now, so as these funds redeem, as these funds are forced to sell, you will keep seeing outflows. And the oil doesn't need to fall from here. If oil stays at 50, means that many of these oil exporting economies will have to continue to sell their assets, and which means that we will see waves of redemptions. And they will be hitting from various funds, because when they redeem from 5 different funds, all 5 funds come and sell at the same time. And no one really wants to stand against them. So that kind of volatility, I think, will continue. I'm not personally, there are sectors like steel and metals where I think clearly, aluminium at 1450, I think iron ore has started to fall again. Those are sectors where the lack of investment demand in China will remain an issue. But I think the real macro issue of China going through a very destabilizing hard landing, I think those risks may have muted quite a bit. At least perception of those risks is actually stabilized quite a bit.
The other popular theme is global liquidity. Fed has not moved. ECB has indicated that they will do whatever it takes for them to kickstart the European economy. BOJ meeting later this week. I'm sure they will commit to following a loose monetary regime. The problem with so much of global liquidity is that it is not adding to global productivity. So there is wall of liquidity and yet no productivity. So what's going on with the world?
No, I think the world is getting increasingly worried about deflation. So if commodity prices stay very weak, and see the another advantage India has is that debt to GDP is, with the exception of a few companies that are massively over leveraged, and we can discuss those. But as a system, we are not heavily leveraged. And therefore, those concerns are quite low, and we are generally a high inflation economy. The problem with deflation, especially if you have a low inflation, a low growth economy as well, is that then the debt becomes unmanageable, right? So people are mortally afraid of deflation, and those are risks which are, I think, prompting some of the central banks to actually in a coordinated way, in a relatively coordinated way, actually get into another cycle of easing. It almost seems like currency wars are back again. So on the one hand, you have the Chinese trying to bring down the currency. And the Japanese don't want the yen to go below 120 to the dollar. The ECB, okay, again, we are seeing the Italian 6-month bond yield that was negative at the auctions today. So it's clearly that that people are really, really afraid of a global growth downturn and deflation, and that's going to prompt more and more of easing. But you're absolutely right. The kind of increase in risk appetite that used to trigger in earlier cycles, that's not happening anymore.
So we've discussed how the global liquidity setup right now is moving. But broadly, if I look at the construct of the market right now, it's not only in India. All global markets are sitting at a record high. For the longest time, we've maintained that India is a special situation country. But it's not only India. Every other major market, with the exception of China, is enjoying certain degree of tailwind, and that tailwind is cheap money.
I agree. And I think the problem in other economies, say let's say Japan or Germany, I mean, if you look at the countries that are actually seeing current account surpluses rise, right? I mean, the macro tailwind from lower commodity prices. So Taiwan, Korea, Germany, China, Japan. I think these are all economies that are struggling with growth. The one point at which we really stand apart from these economies is that we are a naturally high growth economy. And I think that growth is actually picking up as we speak. I mean, if you see signs on the ground, the last 2 months, there are very visible signs that the economy is actually starting to do much, much better than what is publicly believed. And if you look at, say, a Germany or a Japan, I mean, there are aging populations, they are export-driven economies. If China is slowing, there's a very deep China linkage. We don't have that. Same with Taiwan and Korea. They are very export-driven economies. If the global demand is slowing, then there is a natural pressure on growth for them. In fact, what that is triggering is something very, very interesting, which is that if you're as an economy, you have very high current account surpluses. Every economy behaves differently. So if you were an oil exporting economy in West Asia, what the US calls Middle East, but it's West for us, right? West Asia. So they would, because the oil resources were controlled by the government, they were sequestered into sovereign wealth funds and invested in a certain way. In economies like Taiwan and Korea, I mean, there are some funds, but there are insurance funds and so on and so forth. You see that all of these surpluses, so that these are economies which are now running big surpluses, right? And now they are trying to invest, there is an absolute battle going on in Central Asia, right? For battle for supremacy, providing funding. I mean, to some extent, what's actually India is trying to do in the Africa summit. And if you see some of the things that are happening or the suggestions coming from the African side, there's clearly that India should invest more, right? So as countries have more surpluses, there are various ways in which, through either FDI or the government intervention. So there will be different types of behavior. But if you're looking at from the pure market perspective, I think where India really stands apart from all of these economies is that it's a very naturally high growth economy.
But unfortunately for India, earnings are not there. For the longest time, we've made a case that earnings recovery is around the corner, give it one more quarter, and that give it one more quarter is happening from last 4 quarters.
Absolutely. So we wrote today that if you look at 1 year forward earnings,
which is FY17,
it's a time series, so it's a running number, right? So on January 1st, 2015, it was what was the expectation for 1 Jan 16. If I do it now, it is for what is 28th October 2016, right? So it's a rolling forward, 1 year forward earnings. In the last 10 months, it has not changed. We did it for BSE 100, and so it has gone from 504 to 503. It has 2 parts. So there is a roll forward element, because these companies are growing, the private sector banks are still growing profits at 20%. NBFCs are still growing profits at 25-30%. Consumer staples companies are growing at 15%, right? So there are companies which are naturally growing. Pharma companies are growing. And then there is the earnings cuts impact, right? So FY16-17 earnings are falling from wherever they were, but there is still growth. So as we roll forward, the forward earnings keep going up, and which is what has happened is that in the last 10 months, the cuts to earnings have completely offset the roll forward impact, right? And if you look at sectorally,
Can you explain that for our viewers?
yeah. So what has happened is that generally, say if you assume a 15% growth every year, right? Now what happens is, sitting on 1st of April, so let's take financial year, the 1st of April of FY15, your FY16 is your 12-month forward earnings. Now assume 1 year later, on 1st of April 16, you're looking at 1st April 17. Now, if the FY17 earnings growth was 15% over FY16, but earnings growth in FY17 has been cut by 15%. So once you reach from 1st April 15 to 1st April 16, you realize that the forward earnings haven't changed. And which is why the market is flat YTD, right? Year to date, the market has not changed. Now let's look at, so the indices are generally misleading. I mean, no one really invests in the BSE 100, for example, or a Nifty. If you break it down by sector, what you realize is that the globally linked sectors, so metals, energy, and let's say an auto company with a lot of big operation outside, these have seen aggressive cuts, which have far offset the earnings, roll forward earnings impact. So while all domestically focused earnings, companies and sectors, where earnings have cut, but they have been much lower than what the roll forward is. So the 1 year forward for financials, which is mostly private sector, is still much higher. For staples is much higher, pharma is much higher. But for an oil company, a refiner, a metal company, it has been. So all that, so it's a very balanced chart. So on the one hand, all the local companies are adding to earnings, forward earnings, and all the global companies are pulling down earnings. If oil prices stay at 45-50, if metal prices don't really decline meaningfully from here, my sense is that the pace of those cuts would stabilize. Now, even we have been calling, I think for the last 4-5 months, that the index level earnings should start to stabilize. But what keeps happening is that the commodity prices just keep going down.
So now it's time to really look at domestic companies, look inward rather than looking outward. And within the domestic side, for the longest time, you've argued that look at select power companies, select utilities, and also don't ignore road sector.
Correct. So what is now starting to happen is that, and again, we have been saying, I mean, right before the last year's elections and even before that, that the investment cycle will take a long time to come back. And that's so far played out, and I think it will continue to play out. But we have to start being a bit nuanced about it. So, if you said 2 years back that it's going to take 3-5 years to, well, that 3-5 years is now 1 year away, right? So we have to start becoming a lot more nuanced on how things are changing. So if you break down the investment cycle or the investments into categories, so if you look at transport, so there's an element that there's a series that we track, which is projects announced and concrete announcement, not just MOUs being signed, projects announced over the past 12 months, the time series of that. So the aggregate number has doubled from the bottom. The bottom was hit in 2013.
This is in last 1 year.
Yes, last 1 year.
After the change of guard.
Yeah, so it's a time series, it's a running series, yes, but so the current number is after the change of guard. So it has doubled from where we were in the bottom in 2013, but it is still half of where we were at the peak, which was hit in 2010 or so. The moment you start breaking it down by sector, so you look at transport, which is roads, railways, airports, airlines, we are already at 80% of prior peak. So there's been a substantial recovery, of course helped by the government's balance sheet, very, very aggressive spending on roads and railways, If you look at manufacturing, excluding metals, we are at 70% of prior peak. In fact, if you ask steel companies, and I met some senior management just yesterday, simple things like Galvalume, so it's galvanized aluminum coated steel, So Galvalume sales are doing well because solar panel installations are shooting up. Right, so there are areas where, or even say electronic manufacturing. I mean, there's a lot of FDI being announced, and a lot of investments are happening. I think food processing, there is a lot of investment happening. So if you, the moment, these are all small ticket items, so they're not like headline grabbing, 30,000 crore investment plan, but these are all happening and they add up to a big number. So it's already at 70% of prior peak. So we are already seeing a recovery in those kind of investments. Where things are still a problem are in power generation.
That's because of excess capacity.
That's because of excess capacity. And in metals. And in metals, I don't see any hope of any recovery anywhere. I mean, that's more China.
That's a global trend.
It's a global trend.
In our previous conversations, you've said that government spending will increase in roads, which means you buy companies which are building roads. Now you are of the view that the entire supply chain, if I may use that word, or the entire ecosystem for the power sector will change. So is it time to buy utilities? Is it time to buy companies which make...
It is time to buy utilities because, see, there are, so when utilization of the sector starts to pick up, you want to buy the power generation companies or companies that are, transmitting power, which are benefit from when power starts to move. The investment cycle, which is that, the equipment companies, when new capex, new project starts to come, is still years away. I mean, I would not venture.
There is excess capacity.
Because there is excess capacity, and it is presumptuous to assume that this 10% which you've seen for 2 months, I mean, I hope it plays out. I think it should, but it's too early for the market to start believing that.
Because the winter's month, right? So
exactly.
you don't know the demand.
You don't know the demand. You don't know if, so right now Bihar's power demand is going at 40%, right? I mean, so of course the number of households electrified has gone up a lot, but it's also because it's pre-election, right? So Bihar is small, so it doesn't really add too much to the overall Indian demand. But the thing is that there are things that change. So it's too early to play for something which is like 2 years away, right? But there are signs, and especially particularly on the road side, the more I interact with the government, the more I realize that their ambition levels are really high. I mean, they're really trying to reset the aspirations of the government. So the ordering of 10,000 kilometers this year, their aspiration, and they're not giving this as a target, is to do 35,000 kilometers a year.
So what are the mega trends according to you? You've always been a top-down guy. You've said that look at the big picture, then you fill in the blanks. You've really beautifully sketched the black and white picture for us. Let's fill in some colors now.
So I think one aspect which is being completely underappreciated is the value of financial inclusion. Right. So one thing which is happening for sure is that both the Prime Minister and the RBI Governor, right, are completely focused on financial inclusion. And I think it's a very, very welcome and very refreshing change. Instead of just aping Western economists and saying trickle down, build big corporates and income and wealth will keep trickling down. They're saying no, we need to work with the informal sector. I mean, they are these self-employed people, we need to give them bank accounts and give them phones, electricity and so on and so forth. And I think what has been completely ignored, of course, it'll have an impact with a lag, but 21 new banking licenses in 18 months. In the previous 20 years, there were 4 licenses. So the RBI is throwing the market at it. So give a lot of interested, excited people banking licenses and let them work on financial inclusion. The government works by diktat, right? I mean, that's how they're designed to work. So they're saying, okay, open everyone's bank accounts, 18 crore accounts. Now, 20% of those accounts are active. It's an incredible number. 20% looks small. 3.6 crore accounts are doing more than 2 transactions a month. It's an incredible number. 60% of those accounts are actually now have balances in them.
So what will change because of this?
What this does, it changes the productivity at the bottom of the pyramid. What it does is it improves demand, which is why we continue to be very positive on NBFCs, on microfinance companies, on again the best play, unfortunately or fortunately, whatever you call it, is consumption. Because see, there is a macro trend, and I think it will improve productivity. It will improve demand for a lot of things. When you try to translate that into an investment and you run through the various sectors, right? So there is the NBFCs and of course the financial side. Metals, it's a global sector. Refiners, petrochemicals, global sector. You look at autos, there's a very large company with a large market cap, but everyone else in the auto side, I think, will benefit. It's consumer discretionary. Staples definitely will benefit. Pharma, export sector. We like pharma, but it's not going to benefit greatly from this.
And not everything in pharma is doing well also.
Exactly. And IT, again, is not about India. So the moment you start translating this into large investable sectors, which is what we as a house focus on, you drill down to private banks and BFCs and consumption.
Let me get some closing comments from you. Ultimately, when you invest in a market, you have to look at value. You have to look at how much of the current scenario or the near-term scenario is in the price. So currently, how much of what exactly are markets pricing in? Because you have to play for the surprise to make money.
No, I think the markets are still too cautious. I think commentary on what's happening in the economy is far more negative than what I think is really happening on the ground. I mean, you don't see 15% oil consumption growth. You know, you can do the base effect analysis. You can do this. You can do that. Oh, prices are falling.
That's actual growth.
It's growth. 15%, right? Even if there are one-offs, you can 10-11% is huge. I mean, we haven't seen that growth. 15% has never happened in the last 10 years, right?
Power consumption.
Power consumption is picking up. We have seen Navratri sales across India actually starting to do well. I think sentiment is far too negative. I think the economy is actually healing. There is a part of the economy which is under stress, which is because, I don't believe in that hogwash about, Narendra, MSP hurting rural India. I think rural India has been hurt because of its global linkages. So things like milk prices, milk prices, cotton prices, rubber prices, soya, corn, wheat, rice, everything there is a global linkage.
So let me take one word or a leaf from your answer, Bihar. Elections around the corner. What's your assessment? Irrespective of who wins, who loses, you think it's not going to be more than a 2-3% event for the market?
I think so. They will be, because everyone is watching it. I mean, my colleagues were marketing in the US, emerging market fund managers who don't know what pay commission is.
But they have an opinion.
They have an opinion on the Bihar elections, right? So, which is quite funny. But anyway, so I think there will be an impact because people are anchored to it, and everyone expects something to happen. The market is about expectations, so something will happen. But I think it's absolutely non-fundamental.
6 months after the election, when we would be analyzing the Bihar verdict, markets would have moved on.
Yeah, absolutely. I think, so these things keep happening. See, the elections are very important for Bihar. Given how much dynamism we are seeing some of the states, Bihar needs a stable, strong government.
It's a large state.
It's a huge state. I mean, it's as big as Mexico in number of people. And it's an incredibly poor state, competes with Ethiopia and Somalia for per capita GDP. There's a lot that needs to be done. It needs a strong, stable government, I mean, irrespective of which party forms it.
But just to summarize our today's lovely interaction, you are of the view that markets are not pricing in all the good news. There are a lot of on-ground changes which have happened. They are not showing up, and when the surprise would kick in, not only they would surprise markets, they would surprise you and me also.
Yes.
Really appreciate your time. So glad you could join us.
Thank you, Nikunj.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for joining us.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.